Good evening. This is Ken Long from Tortoise Capital Management with a review of a concept that I'm calling the integrated frame-based decision-making using evidence-based context to guide my trading. And what I want to show here is we have integrated a number of time frames to get trades of various dimensions well started. Looking at the past for context, and then we're going to project forward based on trade frames to develop a expectation or an estimate of what a reasonable return for that particular pattern trade is going to be, and that allows us to manage trades routinely and to be able to identify prices at which we are experiencing irrational exuberance, in which case we're going to use a different set of rules to protect ourselves against the downside and to take advantage of gifts from the market when it gets temporarily irrational. So the vertical blue line represents where we are right now. It's always the line that shows we're interested or we're stalking. And I'm going to look back at some representative time frames. Yesterday, D-1, and let's just call that a candle, or from the high to the low, that's the range. When the market opens after the blue line, if price opens up inside yesterday's range, then I call that yellow zone trading. And we can only trade yellow zone trading if we have a 2-to-1 trade frame using the high of the day or the low of the day as our targets and our stops. So you have to be able to see 2-to-1 reward to risk ratio inside the yellow zone. As soon as price goes above yesterday's high or below yesterday's low, I call that the green zone for the long side, or the red zone for the downside. And in the green or red zone, you want to have a position that's aligned with the major trend of the day. That is the beginning of potentially new trending information. Because instead of hesitating or reversing at a place where it found resistance yesterday at the high of the day, it actually goes through it, and now we have information that suggests the market wants to go up. Whereas if it takes out yesterday's low, we now have information that says a price got below yesterday's low, and now it wants to go down. And so that's the beginning of trending behavior. Inside this yellow zone, however, we can't say that. So I want to make sure that I have a 2-to-1 reward to risk inside that area. You can see a previous video hanging on YouTube entitled Green, Yellow, Red Zone Trading Concept for a little more discussion of that. The next time frame I look at is the last 10 days. I use that with Williams % R or my own 10-day NDX. I think that's representative of typical swing trade holding periods going forward, and so I want to know where price is within that last 10-day trade location, so the D-10 time frame. D-30, looking back 6 trading weeks, trailing 30 trading days. And I'm representing each of these time frames notionally with a high and a low of the trading zone, the trading range. I look back at times 100 days, which is almost 5 months, to provide context from a look-back period that's 10 times as great as the swing trade D-10. I consider 100 days to be something like an intermediate term holding or a long-term holding. I also look back 180 trading days. That's about 8 months of trading, and each of these trade ranges have highs and lows that influence price. When price gets to those things that were previously high or low, support and resistance, then hesitation is expected. But if it breaks through, then that breakthrough resistance is likely to yield additional short bursts of goodness. So now when I start looking forward at what is reasonably available based on the patterns and the support and resistance levels of the various look-back periods, a couple things come to mind. Typically, what I'm looking at is swing trade patterns that are going to execute within something like 10 days or less going forward. When I compile statistics on how my different patterns perform in various market conditions, that gives me an estimate of what a reasonable behavior of the trade can be over what period of time. So if I project forward day 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I'm representing about 11 days worth of price action here. And we might say that based on a test of a 10-day high or an average 5 to 8% swing move over 10 days based on winning trades, that if this goes up on the pure efficiency line, then over 10 days it might go up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 units of risk. There might be some kind of trade that fills out there, but it may also get up to one of these local maximums and then start to fail, in which case we have to decide how much of that gain do we want to give back. General idea here is that if you take the average trade over the average length of time and you draw the efficiency line, you'll know whether your trade is accelerating and looking to move faster or slower than the prototypical trade. Now, typically my swing trades require a nickel above or a nickel below the yellow zone, or yesterday's range, in order to trigger, because those are the first pieces of information that says something new is happening. As long as it stays in this yellow zone, it can actually look something like a sideways quiet channel, in which case it's waiting for more news or a change of economic conditions to change price in a significant way. A lot of times the signals to go long, if they fail a nickel below, that's a signal to stop and reverse. It will depend on the pattern, depend on market conditions, and then the behavior of that instrument, and the trader's ability to execute and turn on a dime. So if price opens inside yesterday's candle and stays there for an extended period, it's sideways quiet channel, whether that's one day or multiple days, as I'm showing here. Rational exuberance is that distance from the entry signal up to, well, you could define what irrational exuberance is. You could use statistics. You could use multiples of ATR. You could look at the average winning trades and start plotting out that average move per day in the trade. Maybe add a standard deviation to the upside of that to capture the notion that there is a boundary, a professional boundary that a seasoned trader is aiming for in order to pay bills and to make a living as a professional. And when price gets to one of those boundaries that's shown here by that rational exuberance line and starts to hesitate, then you're entitled to believe that you have seen the best move that it's going to make, and then you're interested now in stalking exits in the same way that traders will stalk entries. So a couple regions of rational exuberance, a sideways quiet channel, and then at some point you have to know, I believe, the boundary between rational and irrational exuberance. In my view, any price intraday that moves an average range plus one standard deviation beyond that is into the area of irrational exuberance. Now, it could be driven by a natural, rational response to a news event or some economic circumstances. But I still think that when it exceeds its behavioral norms over the last 30 days, then you're entitled to say that this is abnormal returns or exceptional movement. And it consequently becomes something you want to lock in to a greater degree than just a routine trade. You want to capture a professional amount of the rationally exuberant trade but you don't want to give back too much of the irrational exuberance money, because that really represents a gift. And once the price gets up into irrational exuberance, if it then turns around and fails, you don't want to give back your professional profits on the side of the fence of rational exuberance. So just because it did what it was supposed to do doesn't mean that it's likely to follow through, especially if it starts exceeding performance norms over that look-forward period. So we can use this idea to help calibrate our expectations for particular trades. We might have a series of swing trade patterns that's set up that use something like a 10-day look back or other technical indicators. But once we actually take the trade, and we can plot these various support and resistance levels and see where the price has hesitated in the past, and then use that as a guide to develop our strategy for trade management. Now, I also want to just show that this idea that when we are trading a particular company, that it's only about 25% of the total price variation can be explained by the company, many surveys have shown. And that the business sector that the target is in is responsible for about another 25% of the variation in stock price. And then the market itself, doing the math, is worth about 50% of the overall price movement available to a symbol. One of the advantages to trade in ETFs is that you can get rid of this company risk and just be trading particular sectors or very large, broad indexes, which really represent markets of their own, in my view. So conceptually, what I do is take a look at systems that work in the look-back periods that I've shown here. The 180 and 100 time frames corresponds pretty reasonably to the 3-month, 6-month look-back period that are blended for the BMR system. A lot of my market indicators use the 100 or the 180-day look-back period to establish context for maximum, minimum, and boundaries of normal for those indicators, so that when they exceed those thresholds, then we have evidence to be able to say we are in a new situation or an energized situation or a situation with great potential. So I carry over those notions of support and resistance and then oscillator status, if you will, and map that going forward into trade frames that allow me to trade these opportunities in a structured way. I'm very interested in the average range of the last 30 days and using that to try to identify highs of the day and lows of the day in the first hour, and then projecting from those two known points relevant and interesting and justifiable one-day, or should I say day one, trading profit targets. That is what helps you estimate on that very first day the difference between rational and irrational exuberance. Frog trading has a lot to say about that as well. But the point again of this integrated approach is to take the information available from longer time frames, and typically those are for signals that I use for asset allocation, like the blended monthly rebalancing or blended quarterly. Will nominate a certain number of targets to the top of the tradable list. We can then study those symbols in a little greater detail to calculate their frog quality numbers and initial stops, and then to estimate the going forward average range and what price that might represent if we have seen the high or low of the day in the first hour, as is typical. So the multiple time frames, they share a standard common framework, a philosophy, a belief about how the market works and what it's trying to do, and there are connections between the patterns that come out of those longer look-back periods and inform the short-term decision-making of traders around the world. Those traders read the market in their own particular way, and so insights from multiple time frames infiltrate the price action on day one. And what I notice is that every swing trade starts with a day one of entry. Every position trade starts with day one of entry. Every long-term, intermediate, or long-term strategic kinds of strategies all have entry signals. Those entry signals occur on day one of that new trade, and so since that's the common feature, knowing how to trade day one effectively after a signal is an important payoff, because it's practical knowledge that we can learn to do and to refine. So integrated look-back periods, establishing decision frameworks based on support and resistance, estimating forward potential based on statistics and performance of previous trades, recognizing the contribution of markets and sectors to individual stocks, to use that to help guide our estimate of what is reasonable and what's irrational. And so when we put that trade template down and we get our entry signal and we're in, and it gets up to the average range and begins to hesitate, then we're justified in saying we've seen the move that we're entitled to believe is there, and so we can cash that, recognizing that as long as the cost of reentry is minimal, we're not giving up much. So, it's Ken Long from Tortoise Capital talking about integrated frame-based decision-making with an evidence-based context provided. Thanks for your attention.